Are you looking to buy a home and you're struggling to avoid paying mortgage insurance? Does it feel like a never-ending catch-up game of struggling, trying to save up enough down payment to avoid paying mortgage insurance? I'm Stephen Burns, and I help home buyers get a mortgage without struggling with the overwhelming process of achieving home ownership. PMI, also known as mortgage insurance, is a hot topic for a lot of first-time home buyers, or just home buyers in general. Everyone wants to avoid paying PMI, or mortgage insurance, and I can't blame you. Who wants to pay extra? However, avoiding PMI is not always the best strategy, and I'll explain more in this video. All right, so what are some questions, some hot topics that a lot of people have when it comes to mortgage insurance? So first, what is PMI? How does PMI work? How much is PMI? Why you shouldn't care? How you can avoid PMI by putting less than 20% down, and no PMI under 20%. All right, so first topic. What is PMI? So PMI is for conventional loans, but mortgage insurance is not only on conventional loans. It's also on VA, FHA, and USDA loans as well, in some form or another. So let's take the definition straight from the CFPB, what PMI is. Private mortgage insurance, also called PMI, is a type of mortgage insurance you might be required to pay if you have a conventional loan. Like other kinds of mortgage insurance, PMI protects the lender, not you, if you stop making payments on your loan. What this means for you. Lenders like to maintain a certain risk threshold, which is usually 80% loan to value, also 20% down payment to reach that loan to value. Paying mortgage insurance allows you to put less than 20% down while still maintaining a low risk factor for the lender. Essentially, this bridges the gap between the required 20% down and the low down payment that you're seeking to achieve. So topic number 2. How does mortgage insurance work? Mortgage insurance allows you to put less than 20% down. It bridges the gap essentially from the 20% down that most lenders require versus the low down payment that you're seeking to achieve. What this does is it protects the lender and allows you to put less down payment and allows them to lend more money while still being protected and maintaining a low risk threshold. The most common way to pay mortgage insurance on a conventional loan is through monthly mortgage insurance. However, there's other ways that mortgage insurance can be paid. It can be paid in a upfront mortgage insurance premium, either being rolled into the loan or paid upfront at closing. It can also be a split premium where part of it could be monthly, part of it can be paid upfront. Then there's also what is called lender paid mortgage insurance, and we'll discuss this more later. Topic number 3 is how much is mortgage insurance? Well, this depends on a few factors: type of financing, credit scores, down payment, type of property, loan amount, number of borrowers, and the term of the loan. Let's jump into some specifics on different programs and see what the mortgage insurance looks like on each of these programs. Let's start with a VA loan. Well, luckily for you, a VA loan has 0 monthly mortgage insurance. However, there is a upfront mortgage insurance premium, also known as a VA funding fee, that you could potentially be exempt for if you have a Purple Heart or at least 10% VA-related disability. That upfront premium, also known as the VA funding fee, depends on a few factors. These factors include the first or subsequent use, the amount of down payment, the type of transaction, such as a purchase, refi, VA interest rate reduction loan, or a cash out refinance. And I'll attach a link in the description with a chart that you can see on what the mortgage insurance premium looks like. All right, let's jump into FHA loans, which is very common for a lot of first-time home buyers. So on an FHA loan, there is an upfront mortgage insurance premium of 1.75%. And this can either be paid upfront or typically it is rolled back into the loan and financed. There are also monthly mortgage insurance premiums that are required on FHA loans. And this is dependent on a few different factors, such as the amount of down payment, the size of the loan, and the term of the loan. On FHA, unless you put more than 10% down, the monthly mortgage insurance stays on for the life of the loan. And if you do put more than 10% down, it doesn't fall off any less than 11 years, 132 months. I will also attach a link to a chart for FHA's mortgage insurance premiums. Now let's jump into USDA loans. USDA loans have a 1% upfront mortgage insurance premium that is also known as a USDA guarantee fee. It's required on all USDA loans and it is 1%. There's also a monthly mortgage insurance premium on USDA loans, which is 0.35%, which is about half of what FHA loans are. And I will also attach a link with the USDA guidelines on the mortgage insurance premium, both upfront guarantee fee and the monthly. It doesn't matter how much you put down or the terms or anything like that of the loan. It is 1% upfront and 0.35 for the monthly. Now let's talk about conventional conventional loans. Conventional loans have a ton of variables on how the mortgage insurance premium is calculated. There's a few ways that mortgage insurance can be paid on conventional loans. It can be paid traditionally as a monthly mortgage insurance premium, but it can also be paid as a upfront or even a split where it's upfront and monthly. And lastly, there's an option for lender-paid mortgage insurance, which again, we'll go over a little bit later. Some of the biggest variables when it comes to mortgage insurance on a conventional loan is credit scores and the amount of down payment. But it also depends on other factors such as property type, such as single-family residence, multi-unit, condo, or manufactured home, the number of borrowers. The more borrowers that there are, the less risk that the lender faces, because more borrowers means less chances of the loan going into default. The term of the loan is another factor. The lower the term, the cheaper the mortgage insurance is typically. And lastly, each lender can have different mortgage insurance rates with the private mortgage insurance companies. Some of them have discounted rates, and it could drastically affect the mortgage insurance premium that you will be paying. Remember, it's all about risk. The better your credit scores, the more the down payment, and the more borrowers means the less risk that the lender has to face. It also means lower mortgage insurance rates. So what are the rates? Well, I've seen as low as 0.1%, as high as 2%. It really depends on all the different risk factors. So one of the other big questions that I see often is about lender-paid mortgage insurance. Some lenders like to market and advertise that they offer less than 20% down payment with no mortgage insurance or no PMI. While in a way this is true, what it really is lender-paid mortgage insurance. So how does lender-paid mortgage insurance work? Well, instead of you paying an upfront or a monthly premium, it gets rolled into the interest rate. So technically you're not paying any mortgage insurance, but the lender is now taking all the risk, and they are now rolling that mortgage insurance into the interest rate over the life of the loan. So what are the benefits of going lender-paid mortgage insurance? Well, it depends on the situation, what the market's doing, but sometimes you can have a lower monthly payment because you're rolling that mortgage insurance into the interest rate over the life of the loan. One of the other benefits is you just simply get to say you don't have any PMI. All right, so now what are some of the drawbacks of lender-paid mortgage insurance? Well, with lender-paid mortgage insurance, since you're not paying upfront or even monthly, there's no PMI to eventually fall off. So it's rolled into the loan for the life of the loan. So there's nothing to fall off. And that means that you are stuck with that higher rate for the life of the loan. So in order to see if this is the right thing for you, you really need to look at the differences in the monthly payment and when that break-even period is going to be, when the monthly mortgage insurance is going to fall off on a borrower-paid mortgage insurance premium. So you'd have to look at that. If you're going to be in the home for a long time, that whole 30 years, then maybe going borrower paid is going to be the better option. Whereas going lender paid, if you know you're going to keep that loan for only 2 years or so, then going lender paid might have a lower monthly payment, and it'll save you money by not having to pay that borrower paid mortgage insurance. Lately, in the last couple years, I've seen that borrower paid mortgage insurance seems to outweigh the benefits and the monthly payments of lender paid mortgage insurance. In the past, I did see lender paid be a little bit more competitive, but lately I just haven't seen that competitive monthly payment benefits as strong. All right, so we talked about mortgage insurance, and now the big question is why you shouldn't care. For most folks, saving up for a down payment is already a monumental task in and of itself. But if you're trying to save up for 20% down, that's nearly impossible for most consumers with this rapidly appreciating market that we're in. So from here, we're gonna jump over there and show you some examples as to why mortgage insurance might not be something that you should care about. All right, so we're gonna go over PMI and why you shouldn't care. All right, so we're gonna go over a couple examples, and let's first start with the scenario that we're gonna be running. All right, the scenario we're going to be using in these examples is going to be started with a $400,000 purchase price, 5% down payment on a conventional loan, primary residence financing, single family home, 740 FICO score, and a principal or a PITI payment of $2,198.65. And PITI stands for principal, interest, taxes, and insurance. We're not going to be using any HOA dues in these examples, just to keep things simple. And as of this date, September 8th, 2021, these scenarios are going to be real scenarios, and we're going to show you the pricing and what the rates and all that stuff would be based on what is available today. And obviously rates, pricing, PMI can change on a daily basis, but as of today, this is what we're actually able to offer. So let's just go ahead and jump into the scenarios that we have to work with. All right, so 2.75% interest rate is what we're using. Only $156 in discount points, which is pretty minimal. And the big one that we're going to talk about today, $114 a month in PMI, monthly mortgage insurance. So let's go ahead and jump back over to let's jump over here. So let's go to the first scenario. So example A, 5% appreciation rate. So what you're probably wondering, where did I come up with this appreciation rate? So let's jump back over here and we're going to go to the FHFA website. And over here, see United States as a whole, since 1991, that is 20 or 30 years ago, has been 232% appreciation since 1991, 30 years ago. Well, we take that, divide it by 30, ends up being about 7% appreciation. And if you just go back 5 years, it's been almost 50% appreciation. That's almost 10% appreciation. In the last year has been 17%, which that's pretty unprecedented. And just in the last quarter, it's been 5%. So I'm gonna go ahead and just take it pretty simple and just use about a 5% appreciation rate annually. So let's go back over to our examples. So let's see, in 2.5 years, your loan balance will be on a 5% down purchase, assuming a 5% appreciation rate. So 2.5 years, your balance is gonna be $358,892. The value, assuming the 5% appreciation rate, is now $451,890. So let's do some math. If you took that $451,890 and you also had the balance of $458,892, that puts you at 79% loan to value. That's less than 80%, and you're able to drop your mortgage insurance if you pay for an appraisal, and it comes in at this value. So that means you've gained almost $52,000 in equity in just 2.5 years. Well, in that 30 months, you averaged $1,700 a month in appreciation. That's pretty hard to beat. When you jump over here, you look over here, and it's $114 a month. So it's pretty hard to compare this measly $114 a month when over here you have $1,700 a month in appreciation. So some of you might think 5% appreciation rate, that might be a little high. Okay, so let's just assume that it is too high. Let's use a 2% appreciation rate, even though we looked at the FHFA website showing that in the last 30 years, it's been 7%. But let's just say that it tapers off because it's been a crazy year. In 4 years, your loan balance will be $345,514. And at 2% appreciation in 4 years, your new value is $432,972. Well, if we do the math, take the balance divided by the new value, you're now at less than 80% loan to value. You've gained almost $33,000 in equity over 4 years. You've averaged almost $700 a month in appreciation. That is pretty phenomenal. So again, you jump back over here, still $114 a month. That doesn't really look so bad. And so if you're over here trying to catch up for that 20% down payment, well, it's kind of hard to keep up with that appreciation rate of almost $700 a month. So how long will it take you to save 20% down? Well, let's just assume that you can save $1,500 a month. Annually, that's $18,000 a year. In 5 years, you'll have about $90,000, assuming that you don't have it invested anywhere, making more money. So using the 2% appreciation rate, in 5 years, that home that you plan on purchasing, it was $400,000, but 5 years later, now that you have $90,000, it's $441,000, almost $442,000. 20% down of that new value is going to be $88,000. That's your 20%. So your new loan balance, assuming you put 20% down, is now $353,305. You just saved almost $7,000 in mortgage insurance over this period because you were not paying PMI. You were able to save that $90,000. The principal, or the PITI payment, which we already talked about, principal, interest, taxes, and insurance, is $2,031. So that's $167 a month cheaper than if you were to just put that 5% down 4 or 5 years ago at that $400,000 purchase price. So what is waiting going to cost you? Well, if you were to put 20% down, your new loan amount is going to be $353,000. But if you put 5% down 5 years ago, your loan is now, after 5 years, $336,000. That's $17,000 in equity that you have gained because you had that appreciation, that monthly appreciation at 2% over the last 5 years. And you can drop $114 a month, bringing the PITI payment down to $2,084. So you can actually start saving money pretty quickly and eliminating that PMI after that 4 years that we talked about. So for the last year, you're saving money. And that's all, it lands up being $53 a month difference between the payments if you put 20% down, completely avoided the PMI, versus the 5% down. But that is significantly more equity by having that $17,000. So overall, that 5% down option seems to make a lot more sense. Now, another thing too is your tax basis is based off of your purchase price. So if you bought a home for $400,000, your monthly tax basis could be $416, but at $441,000, $460. That's $43 a month that's not going towards principal or interest. It's going straight to the government, and there's no getting that back. So another thing you really risk the interest rates going up significantly. We just saw that 2.75% at 5% down. That's pretty hard to beat. It's definitely beating inflation. A 0.5% increase on a $380,000 loan, assuming that you had a $400,000 purchase price, 5% down, that's your $380,000 for your loan. Well, 0.5% rate increase, $102 a month just by going from a 2.75 to a 3.25%. That right there is enough to justify not risking it and having that $114 a month PMI. So what do you think? Are you going to try to save for 20% down, or are you going to put a lower down payment and just start building that equity? As you can see in the scenarios that we ran, even with that 2% appreciation rate, it still builds quite a bit of equity very quickly, and your chances of dropping that mortgage insurance gets very high very quickly. So something to think about as well is, again, we use a 2 to 5% appreciation rate. Well, as we saw in the last year, it was over 17% appreciation rate. Obviously that's not sustainable, but just goes to show how quickly things can appreciate and how much equity you can start building and how quickly you can drop that appraisal. So my thoughts are, if you're looking to purchase a home, the best time to purchase is when you're comfortable, when you can afford it, and when you're ready to buy. And if you're focusing on trying to save for that 20% down payment, you could be chasing a never-ending battle uphill on being able to afford that 20% down payment. So my recommendation is, if you can't comfortably afford that 20% down, or you don't have the ability to save for that very quickly, just get your foot in the door, put 3 or 5% down payment if you can, and get that equity start building and see what you guys can do. If you have any more questions, I have any more scenarios you'd like me to run, I'm always happy to put together some more scenarios in this format to explain what those monthly payments would look like and how quickly you might be able to drop this mortgage insurance. If you have any questions, always feel free to reach out.